What you don't do is overreact. What you do is you get on the phone and you ask questions and you ask for clarification and you ask what the plan is, right? Is there a plan? Or if the plan is to do nothing, that's a bad plan.
Yeah.
Hey everybody, welcome back to Real Investing, where we talk about real investing for the everyday investor. Tim Herriage, your host.
Ryan Harper, media guy.
Co-host.
Co-host, that too.
And today we're joined by Joe Pizzurro. Joe, thanks for being here.
Thank you.
Oh, microphone. Yeah. Whoops.
We got to be able to hear you, Joe.
Yeah, you got to pull it all the way in. Pull it all the way. There you go.
There you go.
There we go. That's our flub for not catching that earlier.
It's fine. Flubs are good.
Flubs are good. So one thing I was telling you off camera is like, one thing that we're passionate about is not talking about how you got started because nobody cares. So let's just get into it. Like, what is multifamily investing and like, how do people come across it? Because like, as I was just saying right before we start recording, it used to be you got into single family and then you did a multifamily and then maybe you become a lender. But like, it seems like now people are just jumping into it.
Well, I heard some of the last episode. Basically, if I jumped in to answer that question of, you really don't have to, you can get away with not doing much work at all if you're a limited partner and say a syndication model. You really are letting someone else handle all the work. So it truly is passive. Now, the general partners, there is a lot of work there. So now if you were going to just go buy multifamily yourself and manage it yourself, yeah, that's a full-time job. But there's ways where you can just be an investor and have a general partnership manage the property or an external property management company. And
so when you have an investor and you are just a partner on that, is that, because like when I hear real estate investor, I'm thinking boots on the ground, doing the work, pulling the comps, doing the things. But when I hear, hey, I'm part of a syndication, I'm like, are you even really a real estate investor anymore? Because then it's just like you're almost buying a stock. And I'm just bringing it up for conversation. I'm not trying to be like, poke knives at anybody,
It sort of is like being a shareholder in the company that owns the property.
Right.
But yeah, as a general partner, yeah, that's pretty much, you're leaving one full-time job for another.
Mm-hmm.
Well, now, the nice thing is, even as a limited partner, depending on how, and by the way, none of this is tax advice, yada, yada, do your own homework, get an attorney, get a tax person, spend extra money, whatever. Like, since I'm a full-time real estate professional, there's certain things that I can do with regards to depreciation from being even a limited partner in a multifamily or commercial syndication where I get treated as if that was a full-time job. So depending on if you're out there and you're a full-time real estate professional, there are some benefits to owning even a limited partnership share where you're treated like a full-time real estate investor. Did I say that right?
Yeah.
Okay.
Yeah.
Now, I'm going to dive right into this. Multifamily sucks right now. I just got a capital call last week from one of the syndications I'm a part of. You're not just so everyone, he's not the general partner. He's not, best I know, he's not involved in the deal even as an LP. But, I mean, capital calls are a real thing. It was a value add deal I invested in 2021. Rates moved historically 3 times, what they were. Cap rates have compressed. Could you just tell people the real frickin' truth about the multifamily market today?
So what I'm seeing today is the debt situation is challenging to make the numbers work, but you're getting a low cost basis compared to 3 years ago. So it's a good time to buy as far as, the average per door, if you can make the debt work. So ways to make the debt work would be a loan assumption deal potentially, or a seller financed deal. Those are things I've been looking at. But even using agency debt, if the treasuries, depending on what they're doing, a few weeks ago you might have been able to get high 5s on interest rate. But maybe not this week. But it has been challenging, and deals aren't cash flowing as well, or some not at all, and a lot of deals are running into problems like yours, where I don't know if yours was a bridge loan, but there's a lot of bridge loans that took place during COVID. They're coming up on their term, and they don't qualify for the extension, and they're faced with either capital call or sell for a loss or another creative way out of
preferred
it.
equity or whatever. That's what's been interesting. And so my wife and I on our single family stuff, it's been kind of interesting with rents kind of flatlining, taxes skyrocketing, and insurance skyrocketing. We have a lot of houses that were cash flowing, call it by 20%, that are now break even. But I was looking at the spreadsheet just the other day. There's millions in trapped equity there that's no longer generating a real return. And I was telling her, I was like, we'll just start selling these houses because they're all below median home price and should still sell at or near the peak for that area, and take 100, 200 grand at a time out of these houses when they sell. Because if you can invest in a multifamily deal right now that works in today's environment, I'm kind of with you. Like, it's just going to work better in the future. I would say, though, I want to know your opinion on this. My personal opinion, one that I invested in last week, actually, seller finance, first, 5% interest on a 10-year balloon. I mean, just can't find better than that, right? We raised like 30% of the purchase price was equity that we were raising, or that they were raising, my friends. But we underwrote it on in place versus pro forma. Could you maybe tell the audience a little bit about how your philosophy's changed in the last couple of years of pro forma versus in place?
Yeah, well, a few years ago, when you're at the top of the market, we're trying to underwrite like a very conservative exit cap rate, and look what happened. So a good thing we did. But now, I'm seeing the exit cap rates aren't as they're more aggressive now because we're kind of hopefully at the bottom or the worst of it, or close to it. But yeah, I think recently I'm seeing more of that where the going in cap and the exit cap are closer together.
Right.
I was going to bring that up because, like, I'm not a multifamily investor, but I'm friends with a lot of them.
But you are on TV.
Yeah. Well, I play one on.
You play
TV.
one on
Yeah,
TV.
yeah. No, but it's just like, unfortunately, the only people I know do it are very successful at it.
Right.
So I have a very biased, skewed view of what being a multifamily investor is. In my mind, it's you buy it at 10 cap and you appreciate the hell out of it to a 5 cap, and you make out like bandits. But then I see all these deals that are going across, and they're all already a 5 or 6 cap, and you're like, where's the meat on the bone? But what you just said makes sense, because it's like you're not looking for that 5 or 6 cap spread. You're just looking for a little bit, I guess.
Well, and it helps because I try to do value add as well. So it helps to have are the rents below market? Is there a lot of classic units? Is there a lot of potential to, you don't have control over the market, but you have control over those things. So is there opportunity to save costs, opportunity to increase revenue? That way you have more control over forcing that value.
Speaking of increasing revenue,
Before, because I'm not a multifamily investor.
Gotcha.
In place versus pro forma. What does that even mean?
well,
Because I don't know.
Yeah,
what
it
that
goes
means.
to the question. So, in place means so you have 100 units rented at $2,000 a month. What you saw a lot in 2020, 21, and 22 was syndicators saying, "Oh, well, we're going to get the rents up to 2,500," and so they would model
Okay.
the exit off the pro forma rents.
Okay, so pro forma would be like the potential future. Okay. So in place is now. Pro forma is potential
Right.
future.
Right.
Cool.
So
All right. Sorry to interrupt your question.
in multifamily they have this thing called a T12. It's the trailing 12 months kind of income statement. And I would say previous to 22, I'd say 2019 through 2022, people kind of didn't even look at the T12 because they knew they could raise rents 20-30%. They could put in a pool or a pickleball court or whatever and get a bunch of people to pay 20% more in rents. So they only looked at pro forma. The investors I know that are super serious with big checkbooks right now are underwriting the in place versus the pro forma. And if you can make the deal work off what it's doing right now, right, with maybe assuming cap rates go down 1%. That's the other thing. So the difference between a 10 and an 8 on a cap rate is not huge, right? Because percentage-wise, it's 2%.
Mm-hmm.
The difference between a 6 and a 5 is about the same because it's about 20%. Mm-hmm. So the more compressed you get, the lower the number, the less you have to move to have real improvement. Am I saying that right?
Yeah.
I'm not a syndicator. I've never done a syndication on multifamily. I have on single family. But how are you seeing rents perform in the assets right now? And second part of the question, are there certain markets you see it going better or worse in?
Well, so all of my properties are in Texas, mostly DFW. So in DFW, Irving is still getting bumps. Fort Worth submarkets, those are the ones I'm most familiar with. We're still getting at least 5% annual increase on rents, not 10 to 12% like a couple of years ago, and that's without upgrading anything.
Right.
So we're still seeing the rent increases, but there's got to be a point where the tenant base can't afford them anymore, and I think we're pretty close.
And you said classic units, and for Ryan's edification, what's a classic unit in your mind?
Untouched, unrenovated. So there's some room to update and charge a premium.
So kind of like they built it in the 90s, and it's still kind of the same Formica countertops and ugly fixtures and all that.
Well, on that note, because we talk about inflation, we talk about the economy, and I know even in single family, it's like it used to be like, hey, let's go to the 9s because you have to. When the economy is where it's at, do people start skimping on stuff just because they can? Because even if it is built in the 90s, because I know a lot of people that have an apartment and they get in their apartment and they're like, it's never been updated, but it still rents.
Well,
so how do you make those calls?
So what I've noticed, especially some of the C-class properties, a lot of the tenants, they don't want an upgraded unit. They want the cheapest one you have. So the more that's been happening, we've been dialing back on maybe we don't need to spend that much on renovations at the moment.
Now, does that decision come from like empirical data, or is it just anecdotal? Like, hey, I'm in the business so much that this is what we're seeing.
That's exactly.
Okay.
Yeah.
Well, and it sounds like, knowing Dallas-Fort Worth the way we do, because we live here and we've been buying houses here for 20 years, that Irving, Fort Worth outer bands have always been more kind of working class neighborhoods, right? And that rent pressure is probably greater on them than others. So it sounds like that strategy really works there, right? You're not in Deep Ellum trying to attract the fancy crowd, right? These are just people that are trying to take care of their family.
Yeah, because like the fancy crowd are the ones that are going into brand new, like, hey, I'm in a brand new apartment in Frisco or a brand new apartment like
Plano, Frisco.
Plano, like what a brand new complex. But as a multifamily investor, you're buying and rehabbing or renovating. You're not. Do you ever get in developments at all? Or is
I have not yet.
Is that something you want to do?
Potentially.
Okay.
Yet. How is occupancy? I've been seeing a lot of reports. So, in full disclosure, that one deal that had a capital call, that's not my only multifamily deal. That's just the only one that's bad right now. So, of course, I talked about it. But I have a lot of good ones. I have a lot of good commercial things that I've invested in that are working out well. Maybe you could talk a little bit about projects you're involved in that are working well, and maybe some of the ones that are challenging a little bit. Like we like to talk about where we screw up, because nobody's perfect. But maybe some that are challenging and how you're taking care of that challenge.
Yeah. So we've got one that it's been 100% for 12 straight months. As soon as someone moves out that's pre-leased, I think partially has to do with the location. It's nestled in a neighborhood. It's also got townhome style units that are rare. They have the little sliding patio. It's got 3 bedrooms, which is also sometimes hard to find. So I think that's part of why they're staying full. But also, it's requiring a lot of strong operations during this time versus if you bought something in 2019, you really didn't have to do anything. Just sell it in a couple of years there, and you're gonna be fine. I think that's not going to work if you bought something in 2022, for example.
Could you talk about, so I'm looking at strong operations as a big thing when I look at the difference in the sponsors I invested in. So if you're out there and you don't know what a sponsor is, that's kind of the general partner, the person in charge of the deal that is raising the capital from the limited partners for the transaction. And when I look at kind of, I get nerdy. It's kind of cohort analysis. Like the ones that are doing well have really strong operators with really strong property management, right? They didn't model on picking the cheapest property manager they could find. They picked the best one. So could you maybe talk about choosing an operator or a property manager if you're in the multifamily space?
Yeah, no, I think that's huge. Collections, leasing, so we used a property management company that's been doing this in DFW for about 15 years. So they have the connections here in DFW where we can pull in, vendors that immediately and at low cost. So they have the network established already. But yes, you asked also about what ones that aren't performing. I think there's one we have that we were getting a little too high, and we had to come a little bit down on our 1 bedrooms to stay to keep the occupancy where we wanted it.
So you had to listen to the market, right?
Right.
I mean, the market say, we like the place,
Exactly.
but the 1 bedroom we don't like it that much. That's key though, right? Because I'll tell you, as a limited partner, I would rather you produce income and like keep the place occupied than have a bunch of vacant units or even free rent is one of those things you see a lot of people throwing out. And it's like, well, yeah, free rent's great if you want to beef up your rent roll. But I mean, you just got rid of 20% of my annual income. So I don't care that you got an extra 10% on the rent that you do get to collect.
That's another thing though, when I look at new deals, the occupancy could say whatever you want it to say, but what's the economic occupancy?
Right.
What's the delinquency?
Well, yeah, I mean, I have a 23-year-old son, and he just got out of college, and he wants to get an apartment or a condo or something with his friend. And we start looking at apartments and condos. The reality is, Ryan, I mean, it's $1,800 period for a 2-bedroom that's in a decent neighborhood.
Yeah.
And they kind of have a budget of $1,000 a piece, and they want to include utilities in that. And I'm just kind of like, I told Jennifer the other day, I was like, maybe we just buy a condo and move them into it. I mean, it's...
And again, everything goes down to personal bias of everything. So, like, last time I had an apartment, I paid $640 for a decent studio. It wasn't even a studio. It had a bedroom. It had this, and it was an HEB, and it was probably like less than 5 or 10 years old when I was renting there. So it was like, it felt brand new. And then, so in my head, that's what it should be. But at the same time, it goes back to the grocery store. If I go to the grocery store and I see a 12-pack Dr. Pepper for $9, I'm like, what's going on? It should be $2.99. So it's luckily I'm not in that situation now, but even as an employer, I have to be cognizant of that, because it's like I have employees that have apartments, and I'm like, oh God,
Right.
How do you, I mean, that's not really, hopefully, actually cut this out because I don't need them. Hey, I need more money. Paul, don't listen. No, but it's just, I don't know. Yeah, it's hard out there.
Yeah.
But as an investor, it's also hard because, if you're a syndicator, if you're just putting money in the deal, like we have a mutual friend who in a situation that's not good and is going to be out a couple more zeros, and it's painful. So it's I think that the thing I'm trying to get to is, at the end of the day, it's still an investment, and investments are never guarantees.
I was reading a newsletter yesterday. The Veterans Affairs, the VA, is encouraging servicers not to foreclose and to continue moratoriums until the end of the year. And I kind of found that newsletter inspiring because it's like, really? I mean, here we are. It's been 4 years since the thing, and we're still doing that. But the question is, as a landlord of hundreds and hundreds of people, do you find the geopolitical and social climate to be impacting kind of the way you operate these units?
Of course, that's something we try to look at when we're looking at location is a landlord-friendly county or city where some areas it's hard to evict people, and you got people just sitting in your units not paying rent for months and months. So, but that's something we have to keep in mind. So there's a lot to think about. Out of 20 deals, maybe one makes sense usually.
What are some common misconceptions that people have?
What I see a lot of now is people got spoiled from the past few years, and they think, I should double my money in 3 years, and that's typically isn't the case. But unless you were hitting it like 2020, you got a 2.9% rate, 80% leverage, and rode the market and sold in 2022 early. Other than that, it doesn't usually work that way.
Do you think the again, internal bias, like 10 years ago, yes, there's been multifamily education circuits out there, but they weren't, 5,000 person events. Now it feels like there's a little bit of that Broadway production when it comes to those. Do you think with that much influx of, I don't want to say dumb money, but I mean, where do you think that has on this landscape?
Well, just like you were saying earlier, let the market handle it. I think the market's going to weed out the people that don't know what they're doing during this time.
Well, as somebody that actively vets sponsors for investment opportunities, probably the best thing I've heard you say is that you're using a local property management company that's been in this market for 15 years. And, just the math is the math. That means they made it through 08 and 09, right? And that tells you that group knows how to manage in up and down markets, or probably more importantly, sideways markets, right? Like, it's really easy, to figure out things going down or going up, right? Because it's kind of, you can't lie to yourself. The sideways markets get really confusing because sometimes your taxes and insurance are going up, but your rents are flat, or your rents may go down a little bit. But, it's like you feel like everything's the same, but mathematically it's not, right? Yeah, it's misleading, isn't it?
Yeah, no, it is. What one thing moves, something else takes its place, and so you feel like you're standing still. But a lot's changed, though.
So when it comes to issues, it's easy as a if you're the owner and you have bad property management, you just fire them. But what if you're just the investor, and you have a bad deal partner, and the deal partner is mismanaging? What do you do? What do you do in those situations?
Well, first of all, as a limited partner myself in deals, I expect this is what I do. I expect a monthly update. It doesn't have to be a call, but a report on here's the financials, here's how we're doing, and then maybe a quarterly Zoom or conference call just to update the investors on what's going on, get input. So if that's not happening, that find out who the other investors are, and maybe put some pressure on the sponsors.
Mm-hmm. Is there a way to vote them out, or?
It depends how your deal is structured and written, but there are ways you can.
It's typically not Survivor. You can't just vote someone off the island.
What is it? They put something over the flame,
But I will say this: being in a bad deal, I think, and it being a sponsor and some other stuff. What you don't do is immediately threaten lawsuits.
Right.
What you don't do is overreact. What you do is you get on the phone, and you ask questions. And you ask for clarification, and you ask what the plan is, and you try to surmise whether or not you're being told the truth, right? Is there a plan? Or if the plan is to do nothing, that's a bad plan.
Yeah. I have a fun question, and because we live in this
They're all
area-
fun questions.
Well, this is a little bit. To me,
He's
it's
over there
more
like,
fun.
why did I do this again?
Yeah. He's like, I gotta get out of here. My heart out is at 137. No, but like, we do live in this era of like the crazy Karens, and we also live in this era of Google where people can just research the hell out of everybody. Have you ever had a Karen that'll be like, call you up out of the blue as a tenant saying, hey, my trash isn't being taken out? Like, is there any horror stories like that?
Not to me, but I've heard of them. Usually, because if you're not on top of it, if you're taking care of it, it's not going to happen. But usually, if it's not being taken care of, the tenants will find a way, someone to talk to.
Mm-hmm.
You know what I mean? They're going to find somebody to listen to them.
Well, look, I mean, looking for Alex's apartment, Jennifer's looking at the Google reviews for the apartment complex. I mean, are the tenants actively coming out and complaining? Because in general, you're always going to have complaints, but in general, if people are being heard, right, and taken care of, they don't go
Right.
start yelping.
So going back to earlier about how our investors of multifamily, are they real estate investors at all? I would say yes, because you're investing in, land and property. But what are some of the biggest differences between mindset between like a single family guy and like a multifamily person?
I would say just your determination to educate yourself, and it depends what you're wanting. If you're wanting to retire and just using it as like retirement income, maybe you want to just be a limited partner. If you're wanting to switch your career and start being a real estate investor, then that you're gonna have to educate yourself and do some work, and but then you have more potential to grow.
Well, because like from the optics side, it does sound like, ooh, I own apartment complexes, I own 10,000 doors. There's a sex appeal to that. But
Doors.
But at the same time is like
Cabinet doors, screen
there's
doors.
a guy I won't name, but I haven't seen him in a while, but he was always like, I own 10,000 doors. It's like, bro, you live at home. You live at your parents' house. Like, I get that you have a 0.00 whatever percentage stake of 10,000 doors, but you can't be going out there. I mean, who am I to judge? But at the same time, it was just like, bro, like, come on now. You look like an idiot.
Well, typically we say AUM because you don't technically own it all.
What is AUM?
Assets under management.
Okay.
But another thing I was going to interject is I also do self-storage. And when you asked about multifamily sucks right now, well, there's some ways to make it work, but also there's still storage that's cash flowing. So that's saving me right now.
When you look, crystal ball time, still not financial advice. When you look at treasury rates the way they are, commercial cap rates where they are, agency debt where it is, what do you think the next 12 to 18 months looks like specifically in the multifamily market? And we can just stick to Dallas, DFW if you want, so that you feel like...
My crystal ball is as good as yours, but I expect now we're hearing maybe there is going to be a rate cut this year. I'm forecasting that there will not be, just to play it safe, and that we won't see. I'm planning long term. I'm planning that what if this drags on another year? Looking at if we have any kind of floating rate, getting another rate cap just to stay protected. It could always get worse. I don't know if any of us are old enough, but when Reagan took over from Jimmy Carter, interest rates actually went up that first year until they corrected the inflation. So who knows, right? But just taking that extra precaution, and if you don't need the cap, you can always sell it, the remaining whatever's left of it.
So a rate cap just limits the interest rate because
rate cap or interest rate insurance, basically.
Yeah, and a lot of sponsors in 2021 chose not to get the rate caps. A lot of them in 2022.
And in 2021, that was when they were cheap to buy.
Right. Well, then by the time it came around, I'd say May of 2022, there was the rush to the market to get the rate caps, and the insurance companies, I bet they made a killing. But no, I mean, like, look, I mean, it's good to hear that you're still getting rate caps, even though, you know, some of the pundits say, well, rates are about to go back down. It's a one-way bet, right? Like, rates go up, you're protected. Rates don't go up, you're protected. Like, I agree with that philosophy, just so you know. What?
I was just like, you know, rate caps and everything. I mean, again, like the rates, the interest rates, all that. I understand it matters, but like in the single family world, it's like, do the numbers make sense? And it's like, it feels like when you're doing the multifamily, you have to zoom out and you have to take so many more parameters and economic data. Like, because there was a deal that Daniel Moore and I were looking at in 2018, and it was in this, I can't remember the town, but it was a steal of a deal. And we're like, man, we could pick this up. But then you start looking at, well, why is it already vacant? And then you look at economic data, and then you look at, oh, this is a dying town. Like, because like year over year, there was an exodus of the town itself. So yeah, you can get a steal of a deal and you can get the real estate and you can get this property, but if there's no population to get in there, what's the point?
Yeah.
You know, so it's like, you know, I felt cool for a second that I was like, I'm going to be a multifamily investor. It's like, or you could be bankrupt because you just bought a property that nobody wants to move into.
Or there's nobody to move into.
Well, that's the point.
Here's a question for you. What are some of the best questions a limited partner can ask when evaluating investing with a sponsor or a syndicator?
I would typically want to know who's the property management company. I would want to see the loan agreement, how much equity needs to be raised, how much has already been raised, how much time to close. Let me see the pro forma budget. Let me see the updated T12 and rent roll and AR aging report, just to see what's happening currently and see if there's any trends. Like, oh, why it looks like their other income is decreasing the last 3 months. Why is that? Or it looks like they have a lot of loss to lease. So then you come up with questions. So the sponsor should readily share those things. If they don't, then I would hesitate.
One of the red flags to me is always when a general partner is not putting their own money in the deal.
Mm-hmm.
It's kind of like, well, we're raising $3 million. It's like, cool. How much are you putting in? Well, nothing. And then you ask the next question, and you find out that they've got like 9 extra general partners involved. Some of them are actually receiving fees for raising capital, so they have zero business being part of the general partner. They had no value whatsoever other than they know a couple rich people. And then you find out a lot of these deals that I was seeing in 21 specifically, the GPs were walking away with $1 million plus in fees at closing. And you were just kind of like, hang on a second. This is cash in for me as a limited partner, and it's cash out for you? Like, where's your interest in helping me if this deal
Right.
has a problem? So I would add that to the list. Like, you know,
Look at the fees.
yeah, look at the fees, but also make sure, like, verify that the main GP or the KP, that's another thing I can't stand. We'll talk about that in a second, is actually putting money in the deal. Make sure they have skin in the game. Skin in the game in all lending, like, is the number one indicator whether or not that loan is going to go good or bad.
Well, you brought up property management. One thing that, you know, I would have assumed is like if it's your company, it's your apartment complex, like, because it is more of a business and like as an investor, you're investing in the company that owns the real estate. Like, I would have just assumed that, hey, the property management is your own little firm. Are there, like, when it comes to property management, is it location based, or is it like there's giant big firm, like, you know, like if I don't know how to ask this correctly, but like if I go to like Scott Belsley, who's a property manager, he oversees, you know, hundreds of thousands of houses or whatever. Mm-hmm. Like, is there property management companies that oversee like just a multitude of apartment complexes that have nothing to do with the management structure of the ownership?
Yes. You know, and then a lot of syndicators, they are vertically integrated, so they have their own property management, they have their own construction management, or, you know, like me, I just use a third party property management.
Which I like better, because if it's a vertically integrated and they're not doing a good job, you can't fire them. if you hire, you know, one of the big five or whatever management companies in DFW, a lot of times they'll put a couple people on site, right? So they will, even though it's not your management company, they'll actually open a property management company like on the complex. But if they're not doing their job, you can fire them. But if I own the property management company, when am I ever going to say, "Oh, that management company sucks," right? Like, I'm not. I'm going to blame it on somebody else. If I own the contract, I hate these vertically integrated ones, just so you know, because if there's a rehab overage, is that GP really going to hold his general contractor accountable
when it's himself?
Right. I mean, it's him. Like, no, he's going to blame it on inflation, right? And then sign the change order and then do a capital call.
Yeah.
Sorry.
It's congressman or senator or president, whatever, that messes up.
Right.
It's like, which one? You pick. You know.
It's like, no, dude, you had bids from yourself, and now you're signing change orders from yourself because you did the diligence yourself, and your management company can't do it. Like, so, I don't like vertically integrated.
You know, we talked about, you know, evaluating like deal partners and like, but how is it you would evaluate the property itself? Like, and whether I'm a syndicator or I'm it's LP and GP, and I always get those confused. Which is GP the
sponsors?
They're the and the LP
general
is
in charge. The limited has limited.
Okay, so the GP is they're the guys that are like managing, and they're the ones that are finding the deals. Is it more important to evaluate the GPs or evaluate the deal itself?
Both. You know, I would look at the market data. You know, what's the median household income in that within a radius like 1 to 3 miles, so you can see if people can afford what you're going to do to the rents, or, you know, is there crime in the neighborhood? You know, there's some software out there like Yardi, CoStar, you can run reports, but then also look at the structure. You know, is there potential foundation problems? And when was the last time they replaced the roof? Does it have cast iron plumbing? Because you might have issues. Does it have a boiler or chiller? You know, those are all things to look at. That, by the way, I would stay away from chillers. I'm typically looking at like 80s or newer, just to not that I haven't before, but every year that goes by, those things get older and older.
Well, I think also, like, so my 2 cents on that, literally I have 2 points. One is if I'm a limited partner, I tend to evaluate the general partner more than I evaluate the transaction. Because if I believe in that general partner, then I should believe in their ability to evaluate the property. But number 2, if I do look at anything of the property, the first question I ask is, why is this asset being sold? Because a lot of times what you see is they've only been in it for a year or 2 and they're selling it already. Well, why? Like, could they not hit the pro forma? Are they having payment issues? The accounts receivable you mentioned. Are they having vacancy issues? Did they miss their target on value add? Are there structural issues that may not, like, I tend to look at, you know, if you got the mom and pop that have owned the thing for 10 years and it's time to sell, awesome. But those quick flips, those in and out, those tend to bother me just intellectually.
So speaking of that, I think you're getting into the risk aspect of it. It's like, you know, when I look at multifamily, and again, this is from a novice and assumptions versus practical, you know, experience. What are the risk factors? Because, like, you know, if I'm getting into this big deal with all these, like, because there's people in my life that if they jumped off the cliff, I'm going with them because I respect them and I respect their brains or respect their brains and whatnot and their experience. Like, it feels like, and this is ridiculous, knowing, you know, I have friends that are getting screwed over right now. Like, how big is the risk when it comes to multifamily? You know?
I think a lot of it just has to do on the debt. Don't get into floating debt unless you have a rate cap, because you never know what can happen.
And what does floating debt mean?
Floating interest rate.
Okay,
Adjustable rate.
Yep.
got it.
I'll speak single family for multifamily. Right?
Hi, I was an artillery and I don't know what to do.
Pull string, go boom.
Yeah, pull string, go boom. But then how do you balance that? How do you balance the risk reward when it comes to that? Like, because like when say those factors are there, does that make you go, hey, I'm not in this deal, or is like, hey, there's a potential huge windfall, so let's jump in?
Yeah, I mean, I would look at just make sure the rate is somehow fixed and protected, and then also, are you overpaying for it? That's another. A lot of times you make money when you buy it. So if you're buying it too high, then you're already upside down.
Right.
And you're.
Well, I think we see that. That's brought up like the newer class of the educational, all these people, and that's what I was talking about earlier about people buying it at a 5 cap. And I'm like, what are you doing? But I'm not in the business, so I don't. Who am I to judge? But I can, from the cheap seats, go, what are you doing?
Joe, not a mistake you've made unless you want to share that, but what's like one thing you wish you'd known or known more of when you got into multifamily now, because hindsight's always 2020, that you could share with the listener?
Well, I'm going to piggyback on from the last episode. I caught a little bit of marketing. I was so busy getting deals and closing deals and raising capital and operations, and I wasn't getting myself out there enough, and that's a huge part of it. So that's why when you invited me, it was raining, and I'm like, you know what, let's go do it today.
And is that just from like when you say get yourself out there from like a syndicator standpoint to find more LPs, or
both? Just marketing yourself in general, because that if nobody knows you, why would they invest with you? You know what I mean?
Right. Well, that's something.
And that's also what helps if you're going to do some kind of like a 506c offering where you can blast out on social media about your deal.
Mm-hmm.
Well, if they're strangers that don't know who you are, why would they put their money with you?
Well, I use this example a lot, especially recently for me. Is you talk about the realtor. And the biggest pet peeve a realtor have is when their family friend or a close one goes with somebody else to list their house or buy the house. And they're like, why didn't you pick me? It's like, oh, I forgot you were a realtor. It's like, we've been friends for 20 years. Right. And it's the same thing. So not to be self-serving as a media company, it's like, that's the power of video. That's that. You have to be out there. And if you're not constantly beating people over the head of what you do, there's so much information in this world. There's people on the internet right now that have 35 million followers that you're like, who are you? I mean, years ago, that would be a legit bona fide celebrity famous person. Now you're just another guy. So like, if you're not constantly like beating people over the head with what you do, they will forget. They're like, yeah, Joe's a cool guy. I like him. He's a good looking dude. I don't know what he does. Right.
Well, what does he do again?
Even my wife, Jennifer, she's been a real estate agent for 30 years probably. She's been a real estate broker for 10 or 15 years. And all the time we run across people and she's like, oh, I would have loved to help you with that. And they're like, oh, I didn't know you do that kind of real estate. Like they look at us and they just think that we're investors and house flippers and Tim runs these big lending companies. Mm-hmm. They don't think, oh, well, Jennifer actually, and by the way, think about it. Who would you rather have on your side? Someone that actively sells houses on their own behalf, always trying to get the most money and protect themselves legally, or someone that does 2 transactions a year, right? Like you'd rather have the person that like literally knows what it's like to sit on your side of the table. Right. But if you're not out there telling people that's what I do or I can help you, they'll never know.
Well, back to the point of like, if we always think we're telling people what we do, like email marketing, oh, I don't want to spam people. It's like, you're not. Like, because like even right now I have advertising out and like, oh, hey, I'm interested, And I'm like, hey, let's get on a call. And then a couple days later, sequence another. One of my coaches was like, no, every single day you send them another email. I'm like, isn't that a lot? He's like, who cares? They opted in. They opted in for your information. So until they opt out or until they buy, you hit them over the head with another daily drip. So the reason I bring that up is, like, to your point, you got to get yourself out there, but you got to tell them, like, hey, I'm doing this thing.
So Joe, we're almost out of time. Why don't you get yourself out there? Tell people who you are and what you do.
Yeah, so Joe Pizzurro, started my company about 4 years ago. I've got close to 100 million assets under management, about 700 units of multifamily, over 3,000 of storage. Yeah, I'd love to meet anybody interested in investing in real estate.
Mm-hmm. And do you have any active? Why, I don't know. Is it SE? This is probably a question I should have asked earlier. Is like, when it comes to like, do you have to be accredited? What are the SEC like rules when it comes to, like?
You are not going to have time for that answer.
Okay.
No.
Okay.
Every fund is different. Every investment opportunity is different. I would imagine if he has a B right now, he probably can't talk about that.
Okay.
If he isn't actively raising for a C, like if it hasn't been properly registered, he may not be able to talk about that yet.
Okay.
I would say that he wants to say, I always am looking at deals and always have opportunities. Get to know me, and I'll let you know when I have something. Something like that.
Perfect.
There you go.
Well, I was gonna ask, like, hey, you got anything you're raising now? And you'd be like, to your point, hey, maybe.
Yeah.
All right.
Maybe.
Well, Joe, thank you so much for jumping on. I know the weather has been fun, and I know this is kind of last minute, but I learned a lot. And that's the whole point of these conversations is to, bring people in from different levels of real estate, and whether it be real estate or real estate adjacent, I think is all relevant.
Yeah.
What do you think?
Thank you for being here, man.
Thank
Appreciate
you.
it.
Yeah.
It's good to see you again. Apparently, we had dinner together, and I forgot. So.
And then we end with Tim looking like an asshole.
Yeah. It's good to see you.
Who are you again? No. All right. Thank you.
Thanks, everybody.